Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the February 14th, 2023 podcast. In today's podcast, we're going to look at key issues concerning the Opportunity Zones tax incentive. Opportunity Zones were created as part of tax legislation in late 2017, with final regulations released in late 2019, about a 2-year span. It's now been over 3 years since that December 2019 release, which means Opportunity Zones have been an active part of the investment world for several years now, certainly long enough to have a significant impact. The Opportunity Zone incentive also has passed some key investment deadlines as we approach the currently scheduled expiration of Opportunity Zones on December 31, 2026. Now, I should note that December 31, 2026 expiration date applies to the ability of investors to make new investment in opportunity funds. At Novogradac, as many of you listeners know, we track qualified opportunity funds and the equity investment made in them. More specifically, we track funds that voluntarily provide information to us, along with funds where there's public information available from sources such as the Securities and Exchange Commission filings or press releases. By the way, if you raise capital for or sponsor Opportunity Fund and you want to be included in our survey, please email us at cpas@novoco.com or reach out to me directly, michael.novogradac@novoco.com. You can also feel free to reach out to our guest on today's podcast. Our survey of qualified opportunity funds is not an exhaustive accounting of all capital raising for opportunity funds. That said, our survey does provide a good look at capital raised and deployed over time and in various areas across the country. Earlier this month, we did release data on investment through the end of 2022. That data showed that more than $34 billion in equity has been raised cumulatively by qualified opportunity funds that we're tracking. And nearly $10 billion of that was raised in the past year. That makes last year, 2022, the most we've seen raised in any year that we've tracked. Our data gathering demonstrates that capital raising and investment in opportunity zones continues to be very strong. I do want to note, though, that the level of reported capital raising in the fourth quarter of 2022 was slower than the first 3 quarters of 2022. That fourth quarter slowdown is presumed to be due to the drop in the stock market and sluggish real estate sales, which reduced the level of capital gains available to be invested in opportunity funds. We will talk more about that and other details from our report later in the podcast. So my guest today is John Sciarretti. It's probably not a surprise to most listeners who have listened to the podcast regularly. John's a partner in our Dover, Ohio office, and John leads the Novogradac Opportunity Zones Working Group. And he did write 2 blogs on the latest data on qualified opportunity funds. And I wrote 2 blogs as well. John's been a frequent guest on Tax Credit Tuesday, often discussing opportunity zones, but he also works in a lot of areas outside of opportunity zones, including the new markets tax credit, the historic tax credit, real energy tax credits, state tax credits. John's an expert on most tax matters related to investments in real estate. Now, in today's podcast, we're going to discuss some current issues involving opportunity zones. And we'll start by talking about potential legislation to extend opportunity zones and the chances of getting such an extension in this Congress. After that, we'll talk about regulatory issues for the opportunity zones incentive, including, or I should say with a focus on those areas being examined by the Novogradac Opportunity Zones Working Group. And then we'll wrap up with some of the highlights from our recent report that I mentioned earlier in this introduction. So we have a lot to discuss. So if you're ready, let's get started. So John, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be back.
Well, I appreciate you joining us. You're always a popular guest for our listeners. So as I mentioned in the introduction, the Opportunity Zones incentive is currently scheduled to expire at the end of 2026, which does seem like a long ways away, but it'll be here before we know it. Now, there were hopes that we'd get some sort of extension legislation passed in the last Congress. Newsflash, that didn't happen. But please explain to our listeners, John, the current state, or maybe talk a bit about what didn't happen and then the current state of efforts to extend opportunity zones.
I'd be glad to, Mike. So it might be good to start out just to kind of remind everybody what was in the bill, but it wasn't just an extension bill. It had 6 main parts. The extension obviously was what I think most folks were interested in. And the extension date was 2028. So that's 2 years from the 26. And the interesting thing about that is it didn't matter when you invested, everyone got this extra 2 years. So that was a fantastic benefit. But it also had other parts to the bill. It had enhanced reporting requirements. That's always been something that I think everyone's interested in getting more reporting around the program. It revived the basis step-ups, the 10 and 15%. And again, generally that was available to everyone, regardless of when you invested. It should have shortened the 7-year 5% to 6% or 6 years. It removed some high income tracks that got some bad press. And I think everyone in the industry, most stakeholders thought that to be a good idea as well. And there was a transition period. And so it didn't hurt folks that had already sort of invested or made some sort of commitment to invest in these tracks. And then it allowed for a funds investment. Currently, QOF can't invest in another QOF. And I see a lot of qualified opportunity funds that made an investment and they maybe pushed it down to a business and the business didn't work out. So they really didn't fund it. They have cash sitting in that business and they decide they just want to join another fund. And it creates a problem because you can move the money back up to the QOF, but that QOF can't invest in the other QOF to get into that wider fund. And so it creates a problem where you either have to merge or go in side by side. And I think that would be the most useful part of the funds of funds. And then lastly, there was this sort of $1 billion dynamism fund, which is basically grants to states to help support their Oz strategy, technical assistance and capacity building and the like. So pretty comprehensive bill. I think everyone was pleased with it and
Would have been more
happen, as you said. Didn't happen. I think it's important to point out, Mike, that the Oz bill was not specifically excluded. It would have had to have been attached to another bill. And there were a number of priority tax extenders that were deferred in 2022, not just opportunity zones. And so there was no tax title in a bill. And so nothing got included. We felt that the stars were aligned for passage in the lame duck session. We thought that the Oz bill, along with these other tax extenders, would be added to the omnibus bill that was being negotiated at the end of the year. And the omnibus bill, as you know, Mike, took a long time to negotiate. And once Congress struck the agreement on that bill, there really wasn't a lot of time left to negotiate tax legislation, which would have likely taken a lot of time because there was a mismatch in the priorities of what tax items would be included. The Democrats seemed to be interested in the extension of the expansion of the child tax credit. And that doesn't mean Republicans weren't interested in it, but that was their main priority. And Republicans' priorities included the extension of all the business tax incentives, like the R&D credit, bonus depreciation starting to phase down. So that was something folks were interested in getting back to 100%. And then the 163J, which is essentially the interest deduction limitations, there was some add backs, primarily depreciation, to kind of help you deduct a little more interest. And that was phased out as well. And so I think Republicans were interested in going back to the table there and maybe getting that add back in that calculation so folks could deduct more interest. So due to the mismatch of these priorities,
Let me just add.
Go ahead.
It did interrupt. Let me just add that you said how we thought the stars was kind of aligned towards getting some type of extenders legislation that could be a vehicle for extending the opportunity zones incentive. It wasn't just us. The now chairman of the Ways and Means Committee, Jason Smith, actually spoke in December saying he thought there was a better than 50% chance that there would be such a tax bill. So, when the now head chair of the Ways and Means Committee thought that, I felt like we were in good company. We were wrong.
Yeah.
We were in good company.
No, that's a great point, Mike. So as I discussed, there's this sort of mismatch in priorities, which means it's going to take a long time to negotiate the tax extenders. And so the leadership, well, actually there was a leadership vacuum too, because no one knew who was going to be Speaker of the House. No one knew who was going to be the Ways and Means chair. And so all that, I think, just influenced Congress to defer any tax legislation at the end of the year. So again, I don't think we should read into this that Congress rejected the Oz proposal. It was only one part of that. So that's important. Now, as far as reintroduction and chances of maybe passing in 2023, we're still encouraged. I mean, I think we're just as encouraged as we were at the end of 2022. It's been a challenging environment this year. Congress has actually gotten off the slow start. It took some time to figure out who leadership was going to be. The priority issue at hand is the debt limits. And that's what you hear in the news today. The government hit its debt limit in January. The Treasury actually has employed these extraordinary measures, which I'm not an expert in, but I think it's an accounting trick to move cash when bills are due so we don't exceed the debt limit. But anyway, so that's where we are now. And that'll take us to July, I think, before we use the extraordinary measures. And then there's some talk that in July, we may get a short-term extension around the debt limit to the end of the fiscal year, which would be September. So now we're in the fourth quarter again, which, by the way, is the typical time for tax incentives to be introduced or tax legislation to be introduced. So we think it might take until the fourth quarter. It's likely to take until the fourth quarter. It could be earlier, but it's likely to take until the fourth quarter. We believe that Oz is still a priority. We know it, or we're told it's still a priority for Senator Scott, who's a senior leader in his signature bill. And so, and all these tax extender priorities, like I said, were deferred and they're still priorities. And there's some other priorities. I know there's like the 1099 limit for third-party payers, which used to be like 20,000. Now it's 600. There's been kind of an uproar around that. I mean, that's something that I think the Republicans want to negotiate. And that's like Venmo stuff, issuing a 1099 for Venmo payments. And my daughter's a photographer and she gets Venmo payments all the time. And I always tell her, they don't give me 1099s when you do these weddings and such stuff. But anyway, so that's kind of where we are. And like I said, I think we're still encouraged that we'll get this added to some sort of tax legislation at the end of the year. I wouldn't sit on your hands. I think it's important to promote the benefits of opportunity zones to your Congress. And I think that's an important step throughout this process. As far as what it'll look like, I know folks sometimes wonder, we have to reintroduce the bill, is it going to be the same bill? And I think largely it probably will be the same bill. I know there's two schools of thought. If you got another chance to introduce it, maybe you add lots of other stuff and get more sponsors, but you're always risking losing the sponsors that you have on the bill. And so it's probably going to look a lot like the original legislation. There are a number of technical corrections that have been discovered and probably will be added to a new bill. And then there is I think there's some hope that we get the Oz designation date moved to past 2028. And what I mean by that is opportunity zones are designated through 2028. So after 2028, there are no opportunity zones to invest in. And so this bill extends the investment date to the end of 28. So say you have a gain at the end of 28 and you're planning on investing in 29 because you have 180 days. And if it's through a pass-through entity, you have even more time, 9 months or so. And so you won't be able to invest that in 29. So it is important that they move that date. And it might be a good thing to move it a little further out for reinvestments and the like, whilst people are still in their 10-year period. So we are hopeful that is one change that gets into this initial modification extension bill. So that's the lay of the land there, Mike.
So thank you for sharing that. And if one of the listeners don't quite understand what John was just saying with respect to the extending of the investment date and all the rest, that's reason to join the Opportunity Zones Working Group. It's issues like that we end up discussing, little nuances that are quite important. And I would also just emphasize, John mentioned the importance of continuing to be advocates for opportunity zones and the like, and how when we kind of go through the narrative and try to analyze when such a bill might pass, it's seeming like fourth quarter of this year, but you got to be ready. Because as John also noted, you never really know, and you don't know what might happen that would carry a tax bill. And you don't want to find yourself planning on fourth quarter and then something happens in the second quarter and you're not ready. So that's why it's important to get the bill reintroduced in getting co-sponsors and the rest. So the moment a train leaves a station that has a tax bill, the opportunity zones can be on it. So thank you for that, John. That's a good overview as to where we stand in terms of extension or other changes to opportunity zones in the coming Congress. I did want to turn the direction a little bit. When President Biden came into office, he did emphasize how opportunity zones could help address the needs of low-income communities. So we all appreciate President Biden's support of opportunity zones. And he also noted that they can be particularly helpful by working in concert with nonprofits. So I wanted just to get your thoughts on ways the administration could use the regulatory process to enact new or clarify existing rules to help opportunity zones incentive better drive positive outcomes in low-income communities. And I know in particular, the working group's been focused on a lot of things, but including how to drive more investment into affordable housing and how to drive more investment into operating businesses and opportunity zones.
Yeah, thanks for that, Mike. As we were somewhat surprised that there hasn't been any regulatory enhancements to help the administration's policy goals in the last couple of years. We were surprised when opportunity zones were actually in the policy goals. And then we figured one way to affect that was to do that through the regulations. And it really hasn't happened. We actually, as the Opportunity Zone Working Group, we made some recommendations to the administration on the ways that we thought that opportunity zones could be used to increase affordable housing in low-income areas and increase operating business investments that could provide more jobs in these low-income areas. And so those are the two things we focused on. And from a housing perspective, when you look at the substantial improvement rules in opportunity zones where you have to sort of spend more than you bought it for, it's a much higher bar than what the low-income housing tax credit substantial improvement rule is. And so I think low-income housing is around $7,000 a unit that you have to spend, which, may or may not be as much as you bought the property for, but probably more times than not, it's not. So we thought if they relaxed that standard for low-income housing, it'd be an easy way to promote more affordable housing in opportunity zones. In addition, there's this really complicated special inclusion for partnerships. And so right now at the inclusion date of 26, where it is now, you have to pay the tax you deferred unless you got some step ups. Primarily you look at the fair market value investment and you pay the tax on that or what you defer. When you look at affordable housing, those projects typically don't appreciate and even depreciate because of the rent limits on those projects. And so we thought it would be a great incentive if affordable housing investors could take advantage of that decrease in value and perhaps pay a little less at that inclusion date. In this special amount includable rule prohibited or precluded investors from taking advantage of that. And so, there were actually funds in the beginning with just looking at that as part of the benefit of their fund. And they were totally focused on affordable housing. And because of this special includable rule, they left the marketplace. And so we think it would be very good in an easy regulatory fix exception for that to be implemented. And then from an opportunity zone business front, the popular interim gain deferral is something we thought would help operating businesses because they tend to be shorter holding periods. And so what that means is that if you have a gain before the 10-year period, you don't get the gain exclusion on that. You have to hold it for 10 years. And operating businesses might have probably more likely a 7-year time horizon. And it'd be nice for investors to be able to still roll over those gains and other investments at a shorter holding period. And that would enable that. We think it would facilitate operating business investments, as well as there's an issue with the substantial improvement test too for pre-existing businesses, because you have all this old tangible property sitting around and it affects your 70% test at the business level. So we thought there could be some exceptions there as well. So, and then lastly, we were looking at the new market tax credit and saying, hey, they have this portion of business rule where if a business doesn't qualify the wider business because you might be in a number of locations and the like, then you can draw a soft circle around activity of that business and call that the qualified business. And so we thought that would be helpful in opportunity zones as well, because businesses operating in opportunity zones, if they have divisions outside of opportunity zones, that wouldn't disqualify the business as a whole. So you can just look at that activity. And so those are some of the things that we actually proposed and keep trying to get this done. So
thank you for that, John. I'll include in the show notes a link to the letters that the Opportunity Zones Working Group had sent to Treasury with respect to the affordable housing related matters that you went through, as well as the operating business items that you referenced. I'll also note that given that we are now in a divided Congress, I do think the White House will be extra focused on regulatory matters, since those are within the White House's control or within the administration's control. So I do think that while last year, maybe there's a little bit of a more focus on legislative efforts to the detriment of regulatory efforts, I do expect a strong focus on regulatory matters. So I think our chances of getting through some of these is greater over the coming 2 years. I'll also note here, we're talking about recommendations to the administration about ways to drive more positive outcomes in local communities through some regulatory changes to how opportunity zones work, or at least clarity, as opposed to may not all be changes. There's also potential for the Treasury to revisit how entities certify instead of self-certifying, having an application process or a more robust self-certification process. So that's something I know the Opportunity Zones Working Group is continuing to monitor, and it's something that listeners should be mindful of, because there could be changes in that area as well. But let's not go down that tangent. We have a lot I want to cover, and I don't want to leave regulatory efforts just yet, because I know that the Opportunity Zones Working Group is also focused on decertification, getting some additional clarification there, and more clarification on the working capital safe harbor. So if you could describe the Opportunity Zones Working Group's efforts in both of these areas. First, you can briefly mention what the area is, and then what the Opportunity Zones Working Group is looking to achieve. And you can give it a very high level, and I'll once again attach some of the information that the working group has submitted to Treasury on these areas as well.
sure thing, Mike. So with respect to decertification, which is happening more now than would expect because of the macro economy, COVID and the like, where folks couldn't carry out their plans because the environment is so much different. And folks would like to voluntarily to certify, but there's no guidance. The regulations actually have a reserve section for decertification. So they are clearly going to provide guidance around how to decertify, or what the guidance is around decertification, both voluntary and involuntary. And I think the latest is they were supposed to release that guidance at the end of 2022, but we have not seen it yet. So we're hopeful it happens quickly. But like I said, there's currently no guidance. With respect to voluntary decertification, our suggestion is to make it a decertification process, just like a certification process.
Right.
But folks can leave when things don't work out without any sort of penalty for doing so. So that's the extent of the voluntary, and we've drafted some language around that. And then from an involuntary decertification, what that means is that folks just aren't playing by the rules, where the IRS, can decertify at their own discretion when taxpayers are purposely not playing by the rules. And so our suggestion there is to have really clear guidance, what it means not to play by the rules. We think that it should be based on sort of a willful neglect standard, in that they're really clear in the guidance, so folks aren't worried about faults. Involuntary neglect. But so that's the decertification side. Like I said, we're hoping we get some guidance around that soon. And then there's still some questions around the working capital safe harbor that you mentioned. He's done a really good job. I think it started out trying to make that a multifaceted provision in the regs, where a lot of things rely on the working capital safe harbor. Started out being a very difficult challenge to making the guidance clear. but they've done a nice job of modifying those rules around the working capital safe harbor. But there's still some things that need addressed. The main thing is clarity in order to satisfy the requirements of the working capital safe harbor. The third prong of that test is you have to be substantially consistent with what you said you were going to do. And we don't really know what that means. Businesses have a lot of challenges and they, as a result, modify their plans regularly. And especially in the last 3 or 4 years, where the challenges were even more with the pandemic and now the macro economy and the like. And so things just don't necessarily work out like we planned them. And so we just don't know what it means to be substantially consistent. And so that's our primary question. And then if plans need to be amended, how big a change do you have before you actually have to amend the plan? Number one, and when can you do this? There are some provisions for these amendments in the event of a national disaster, the pandemic. But what about if it's not related to a national disaster? We're going to be losing that designation soon, which is a good thing.
Yes, it is.
But so those are some of the questions we have around the working capital safe harbor. So those are the two main things, Mike, in the regs that we're interested in and our members are interested in seeing a little more clarity around.
Great. And I would note also, as we've discussed before, there's also the notion of maybe getting more streamlined approach to relief for late regulatory elections. But
yeah, indeed. Yeah.
And that's just something that we could go on with other topics as well, which serves as a good segue to remind listeners. As I mentioned earlier, you can become a member of the Opportunity Zones Working Group, and I will provide John's email address and a link to the Opportunity Zones Working Group's webpage in today's show notes. There's a lot of reasons, a lot of benefits to being a member of the Opportunity Zones Working Group. But let me also say that we do welcome your thoughts on some of the issues we've discussed so far, irrespective of being a member of the Opportunity Zones Working Group. Please email those to cpas@novogradac.com, and that email will be in the show notes as well. But do give serious consideration to joining the Opportunity Zones Working Group to stay current on matters, discuss issues you might have, and the rest. But anyways, I won't go into too much of a sales pitch on joining the Opportunity Zones Working Group. There's lots of benefits. I'll leave it at that. So John, let's now talk about something a little bit more broad with respect to the Opportunity Zones incentive as it stands today. We talked earlier about getting it extended for potentially 2 more years. As it stands today, the Opportunity Zones incentive does sunset in less than 3 years. And even if we get it extended for 2 more years, I know that the working group is also focusing on a second generation OZ, an OZ 2.0, if you will. So if you can share with our listeners some of the working group's efforts here, and this, maybe to frame it for our listeners, this is the notion right now, there's the effort to get an additional couple of years, but then there's also this other effort to develop this Opportunity Zones 2.0 that would kind of be the next generation. So if you could share with our listeners some of the working group's efforts here and your thoughts about what a next generation OZ might look like.
Absolutely. So, all the work that's been done, all the money that's been raised, and it's been a successful program as far as raising capital, is going to be over in 2026. And we're hopeful we get it to 2028 or maybe 9, depending on when the bill gets passed. But I think it's been a success from a perspective of attracting money to low-income communities. No one can argue with that it's been a success. It's been a tremendous amount of money invested. And so we would like for it to be extended further and maybe in perpetuity. But the significant changes to tax legislation that I think would be proposed, other than a further extension, I think there's a lot of things that folks are interested in seeing changed. And it takes a lot of time to make significant amount of changes. It takes a significant amount of time before a bill can even be proposed. And so modifications that folks are interested in They got to be prioritized. There's always a cost to them. So you got to understand the cost. Could be a great idea, but it's got to be, it can't cost too much for the value it presents. And then the time to draft the bill and secure sponsors, and then get all this ready in time for it to wait around for the right legislative vehicle. So it's not too early to start. That's where we are now. And so we actually have started conversations with our members. Our members are interested in being part of this discussion. And most of them were not part of the discussion the first time around. So now they get to have a voice. And so I think they're really pleased about that opportunity. And they have lots of ideas on how to make the incentive more beneficial to low-income communities, as well as more attractive to investors. And so that's where we are. And once we get our own list of priorities, we intend to work with the Economic Innovation Group to help to communicate all those priorities to Congress. And so that's kind of what the working group's been doing with respect to 2.0. Some of the things that our members would like to see, there's a lot of things, but I think the most popular item is permanency. I mean, we would like to see this extended indefinitely. And then the interim gain deferral is something that folks are interested in. We kind of talked about it from a regulatory change, but there's some question of whether you can do that through regulations. But so it'd be important to get that in the next generation of opportunity zones. And then additional incentives for impact investments, we think would be a fantastic add-on to the opportunity zone incentive. And so folks have ideas on how to structure that. We're talking a lot about that at this point. And then a number of technical revisions that I'm not going to go into now, but things that would help facilitate the structuring and operation of qualified funds and qualified businesses. But, like I said, I'm not going to go into the details of it all, but if any of your listeners would like to be part of the conversation, do please consider joining the Opportunity Zone work.
And I would just add to that, in addition to modifying and enhancing the level of incentives, along with how Opportunity Zones operates to make it more efficient in bringing capital to distressed communities and benefiting residents of the communities. There would also, as part of that, be a redesignation of some. The Opportunity Zones themselves need to be redesignated periodically based upon new data and the rest. So that certainly plays in with this 2.0 as well. And thoughts that listeners have on that are always appreciated. So John, now let's turn to the Qualified Opportunity Fund report that we at Novogradac recently released. And as I noted, you and I each wrote 2 blog posts apiece on that release. And this is the December 31, 2022 update to our tracking report. Now, as I did mention in the intro, in 2022, nearly $10 billion, billion with a B, in capital was raised by qualified opportunity funds that we track. And the total capital raised for the funds that we're tracking is north of $34 billion. Once again, billion with a B. So John, as you examine the data from that report, what stood out the most to you, or what are a few of the things that stood out the most?
I think what stood out the most, you've already mentioned, but there was a definite slowdown after the first quarter of 22. The first quarter was our biggest quarter ever, and it's over $4 billion was raised in the first quarter of 22. If you look at the macro economy, interest rates didn't really start going up, and the stock market didn't go down as much, and things took time through the end of the year to where in the fourth quarter, we had as much as 400 basis points of increased interest rates in 22. And so, as you mentioned, the stock market was down, the volume of real estate sales were down, and the volume of M&A activity, which came off a huge year, I think a record year. We see a lot of episodic gains of businesses selling and those gains being invested into opportunity zones. So for all those reasons, I just think there wasn't as much raw material or fodder as to invest. And you saw a major drop in the fourth quarter. There was only 1.4 billion invested, which was like 14% of the year. Prior fourth quarter, it was over $4 billion and over 40% of that year. So that's probably the thing that stood out the most. Other than that, I mean, I think things were fairly consistent with respect to investment type. Our report, which tends to be the larger Well, I mean, we have a number of funds. We're tracking like 1,200 funds, but I'd say the primary investment is real estate. I think that's consistent with the wider country, right? We always say our report is the actual investment is probably 3 to 4 times what's in our report, but I think we report on the major funds that are in this marketplace. And it's interesting, Mike, there was a U.S. Treasury report that was released in the fall, which had actual data from tax returns through 2020. They're a little behind our report, but obviously more comprehensive because they actually have the tax data. And the 2020 total assets in QOF was 48 million. So we were at
Million.
billion. A billion, sorry, billion. Yeah, they missed a lot of tax. So we were at 15 billion. So it sort of validates our thoughts that we're only about a third of the marketplace. But it's definitely the trends that we can see and the like is very telling subset. So
I would say the big differences are that the Treasury has all the if a corporation's investing in a fund that they're managing themselves, they wouldn't be part of our data. And they have a lot of individual funds that are managed by an individual that wouldn't be part of our data, because ours is more those that are out there raising capital from third-party investors. So one of the things that I really like about our report, in addition to tracking the capital getting raised, is we're also getting information from funds as to where they're investing the dollars. And our blog posts include a list of the top 50 cities, as well as the top 20 states for planned opportunity zones investment. And once again, funds themselves raise the capital, then they in turn invest in businesses throughout the country. And it was interesting to see where cities and states ranked. And it was great to see that the top 50 cities for planned investment are scattered across the nation. And they represent 25 states along with the District of Columbia. And that the top 10 states represented every major region of the United States. So it was great to see that opportunity zones investment is so effectively geographically distributed. And I was wondering what you think some of the main drivers of that geographic distribution are.
Well, I think first and foremost, every state has a comparable number of zones, which is
Fair enough.
in real estate investing tends to be local. And so that combination is one of the reasons. But I'm fortunate enough to work with what I'll call an exceptionally talented group of fund sponsors. And they're really excellent at finding value in the secondary and tertiary markets across the country. And so these communities that otherwise wouldn't be able to attract outside capital are attracting it. So that again, I just think the incentive appears to be working as it's intended.
No, that's a good observations. I know initially there was this notion that all the investment would go in areas that were going to generate higher returns and all the rest. And then I guess the thinking at the time that you and I talked about was, the incentive is rolled out, there'll be lower hanging fruit, if you will. And then that fruit will get picked.
Right.
Have to go to the fruit that's hanging up a little bit higher in the tree. And it does seem like we've seen that over the course of the last few years as the investment gets more and more geographically distributed, as the incentive is working as you would expect it to work. And that's all great to see. I did want to see if there are any other details in the report that particularly stood out to you before we move on.
It'd be worth mentioning, since I'm from Ohio, that Ohio, although being 9th on the list of fundraising, which is a pretty good number, they ranked first as far as the number of QOF funded projects at 323 in our survey. Obviously that's our survey, but that was nice to see, being my home state. It probably has a lot to do with the opportunity zone tax credit in Ohio.
Yes.
There's not a lot of these out there in the States, and I thought we would see more through the years, but Ohio's been very successful with the program. It's a $50 million program. It was opened as a $50 million program. They doubled it to $100 million for 2023 and 2022 and 23. And so it's been real successful with attracting investment. They also opened it up to non-Ohio taxpayers. So that was good. As long as you, and
Yeah.
your fund does have to be 100% invested in Ohio to get the credit, but it's definitely, I think, driven or attracted fundraising to the states.
No, I've been surprised that more states haven't similarly created a state credit or something else to attract capital, because you definitely see that in other incentives where the state will create an add-on incentive to attract capital from other states to that state. And maybe we'll see more of that in due course. I know that Jason Watkins, who works with you on the Opportunity Zones working group every month, one of the things he talks about are what changes are happening in opportunity zones at a state policy level. And that's always one of the many highlights of the monthly calls. So John, thank you for joining us. You provided some very helpful insight into what's happened and more significantly, what could be happening regarding opportunity zones. So do stick around for our off mic section. I always enjoy that part of the podcast where I get to ask guests off topic questions, and you'll have a chance to give some additional advice to our listeners, albeit it won't be directly related to opportunity zones. Might be some indirect applications. Let me also say to our listeners, please do tune in next week. My guest next week will be Austin Power. He, like John, is a partner in our Dover, Ohio office. And Austin is going to discuss in detail the specific reporting requirements for new markets tax credit allocatees. And if you're not familiar with new market tax credit, those allocatees are technically community development entities, CDEs. Austin is going to discuss how an entity's, a CDE's compliance or failure to comply with CDFI fund mandated reporting can affect the likelihood of receiving future new market tax credit awards. So now we're on our off mic section where I get to ask guests some off topic advice and seek some words of wisdom from them. So John, I have another news flash for you. We're in the midst of audit and tax busy season. So I was wondering, in the midst of audit and tax busy season, how do you keep your priorities straight in terms of ensuring that you're on track and focusing on doing the most important things?
Busy season is the easiest time to keep your priorities straight because everything is a priority, no matter what you're working on. So that's kind of, you don't have to think about it much. I think the most important thing is to be proactive and communicating with our clients, information that we need when we need it, and then setting reasonable expectations for our deliverables. And fortunately, I have a great talented team that gets all that right. So that's how I would answer that question.
So to summarize, I would say, make sure you build a strong team.
Yeah, there you go.
I like that. The team, it's all about the team. So another question I like to ask guests, I don't think I've asked you before, is what's the most useful app on your phone? And tell me why it is that it's the most useful app.
Most useful app. I haven't thought about that much, Mike. The apps I use the most are Microsoft Outlook and Teams.
Yeah.
Why they must be the most useful apps. Especially the Teams app, it's really allowed for timely and seamless collaboration with the team and the like. So I really like that. I don't use my phone for much else other than Googling and things of that nature, but I've downloaded a number of apps to help me better plan and organize my life, and I've always abandoned. I always wanted a Maps app, which I use all the time, right? We all use a Maps app where I can insert personal goals and it could help me navigate in real time and reroute me when I get off track. So I think that's stuff that I'm still waiting for. And I think that would be my favorite app if it ever did come to the marketplace. So,
well, thank you for that. I totally agree with you in terms of that. I've had downloaded so many to-do apps and all the rest, and they never kind of streamline and fit in my own operation. It's always nice when you get something that actually does kind of fit in. And I agree with you on the Teams app. I would definitely put the Teams on the list of my most useful app on the phone. And it's a relatively recent for us at Novogradac to broadly adopt Teams, but it's been quite remarkable. But your point about this app that you could put in to-dos and all the rest and keep you on track and all the rest, since we do have our innovation group that does a lot of programming and trying to help technology enhance our business. We'll have to talk to Brad Weinberg, who heads up that group, and see what he can develop. So thank you again, John, for joining me on the podcast today, particularly in the height of busy season. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes. You can find related links referenced in this podcast in our show notes at www.novoco.com/podcast. Novogradac Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.